Welcome to the deep dive. Today, we're tackling something pretty ambitious, I think. We're synthesizing this a really diverse stack of sources. We've got everything from behavioral psychology, micro habits.
Right, all the way through tax law, complex investment theory.
And even, urban architectural history. It sounds like a lot.
It does sound a bit chaotic
Good
on the
fun.
surface, yeah. But these areas that seem so different, mindset, money management, they're actually, well, they're the essential ingredients for building real, durable wealth.
Oh, okay.
You just can't get long-term success in real estate or really any investing if you're brilliant at one of these, but, completely drop the ball on the others.
Right, it's the whole system. So our goal for you listening is, well, it's simple but maybe challenging. We want to help you connect these dots.
Turn it into a coherent, actionable system.
Exactly. We're pulling out the concrete rules, those hidden tax advantages, the surprising behavioral stuff.
The things that actually guarantee long-term financial success, pretty much regardless of what the market does next week.
We're trying to systematize that path, basically. Help you become really well-informed faster.
Yeah, we're definitely going beyond just summarizing what each source says. We're digging deeper to find those underlying structures, the frameworks that let a consistent investor really thrive.
Okay, so let's kick things off right where the sources start, which is that foundation, personal effectiveness.
Makes sense. You got to start there.
And the evidence we've seen is just overwhelming, isn't it? Monumental success. It's not usually from one giant leap.
No, not at all. It's the small, consistent improvements day after day. It's basically compounding, but applied to your own discipline.
Right, compounding habits.
Yeah, and we tend to, romanticize the big moments, the huge launch, the massive sacrifice.
The overnight success story.
Exactly. But focusing on that completely overshadows the truly transformative power of just making tiny daily improvements. It's less glamorous, but way more effective.
And the math behind it is, well, it's either really motivating or frankly terrifying, depending on which side you're on. If you manage to get just 1% better at something, say, your investment research or your savings discipline, just 1% better each day for a year.
You don't just get, 365% better?
Not even close. You end up 37 times better than when you started. That difference it's structural. It's huge.
It really is. And the flip side is just as powerful, or maybe, like you said, terrifying, if you let things slip by just 1% each day.
Doesn't sound like much day to day.
Right. But by the end of the year, you haven't just had a few minor setbacks. You've basically declined almost all the way down to zero.
Wow.
So that's a critical insight, The path to wealth involves compounding gains, obviously. But the path to failure, it's often this slow, almost unnoticeable compound decay.
Which means our habits right now, we're basically charting our future course. The sources connect this micro-action idea directly to big goals, right? Okay. They say setting big goals demands forming big habits.
Absolutely correct. Your daily habits, both professional and personal, they act as one of two things. Either they're an empowering platform, giving you that solid base to scale up to the next level,
right,
or they become a restricting box. They trap you, ensuring you just stay stuck at your current level of effectiveness, no matter how ambitious you feel.
So the difference isn't really ambition, it's the actual routine you follow today.
That's it.
Okay, so if we buy into that, how do we actually force ourselves into that kind of disciplined routine? This concept of the 12-week execution system seems like an answer.
It is. It's a really powerful way to operationalize those habits. Essentially, it's an exercise in shortening your time horizon.
Instead of thinking about the whole year.
Right. You shrink your focus down to just a 12-week cycle, and what happens? You immediately lose the luxury of procrastination. Suddenly, execution isn't some vague long-term plan.
It becomes something you have to do today, right now.
Exactly. It's a daily, even moment-by-moment necessity.
And within that system, the sources highlight two really key concepts we need to get right: accountability and commitment. A lot of people think accountability just means, facing consequences if you mess up.
Yeah, and that common assumption really holds people back. The 12-week year framework flips that script. It fundamentally redefines accountability not as consequence, but as ownership.
Ownership. Okay, unpack that a bit.
It's a complete stance you take in life. It means acknowledging your role in all outcomes, the good and the bad. When you fully accept responsibility for your actions and the results they create, that's when you're truly empowered to actually drive change.
Instead of feeling like a victim of circumstance.
Precisely. You stop blaming external factors and start looking at what you can control.
That distinction, ownership versus commitment, it feels subtle but important.
Oh, it's vital. Commitment is the intellectual and emotional binding process that has to come first.
Okay.
The sources define it as the conscious decision to take specific, targeted action to create a result you want. Commitment isn't just, wishing for something.
Or hoping it happens.
Right. It's putting your feet to the fire, deciding that the action will be taken, period, regardless of how you feel that day or if it's inconvenient. Ownership is the mindset that follows through on that decision. Hashtag 1.2 general investment stability and risk management.
Okay, so once we accept that ownership over our outcomes, like we just discussed, the next logical step seems to be applying that same disciplined mindset to our capital.
Makes sense.
Before we jump into real estate specifics, maybe we should understand the basic risk benchmark, the stock market.
Yeah, that gives us crucial context for comparison. And if you look at the historical stability of holding common stocks for really long periods, the data is pretty remarkable.
What does it show?
Well, since 1950, if you held a diversified common stock portfolio over any given 25-year period, the average annual return has consistently been just slightly over 10%.
Right, that 10% figure gets thrown around a lot.
Yeah.
But what's the real takeaway for someone investing for the long haul?
The key insight, I think, is how dramatically the variability decreases the longer you hold the assets. Over short periods a year, 5 years returns can be all over the place, very volatile.
Yeah.
But stretch that out to 2 or 3 decades, and the market tends to smooth out those bumps. This historical pattern makes achieving generous rates of return on common stocks reasonably sure, which really reinforces the whole foundation of a life cycle investing strategy.
But, okay, the stock market isn't operating in a vacuum, right? It has to compete for investors' money, especially against safer income options like bonds. How do interest rates play into this?
This is one of the most critical relationships in all of macroeconomics. It's huge. When interest rates get high enough, they offer a really stable, profitable alternative to risking money in the stock market.
Okay.
The sources point to the early 1980s as a really stark example. Back then, yields on prime quality corporate bonds actually soared to nearly 15%.
Wait, 15% on a high-quality corporate bond. That's essentially a guaranteed or very low-risk 15% return.
Exactly.
So why on earth would anyone put their money in volatile stocks if they could get that kind of return safely?
That's precisely the question investors ask. Money flows to where the returns are easiest and safest to obtain. So, to counteract that huge pull of capital towards bonds, the stock market has to become radically more attractive.
Meaning prices have to drop?
Prices have to fall. They have to reach what the source calls bargain basement prices. Low enough to offer a big enough potential reward, a risk premium, to lure investors away from those juicy, high-yielding, safe bonds. It just clearly shows that stock market valuations are always relative to the alternative interest rate environment. Hashtag 1.3 leveraging tax-advantaged accounts IRAs.
Okay, that connection between interest rates and stock prices is crucial context. Now let's talk about getting a structural advantage, basically, using the rules of the financial system to get better returns.
Yes.
And probably the most powerful tool right off the bat for almost anyone is the tax-advantaged retirement account, like an IRA.
Oh, absolutely. The advantage you get from tax deferral here is just so massive. It creates this huge gap between people who utilize these accounts and those who don't over time.
So let's walk through the mechanics. Let's take a straightforward traditional IRA contribution.
Okay.
Say an investor is in the 28% federal tax bracket, and they contribute the maximum allowed, let's say $5,500 for the year. What's the immediate, maybe non-obvious benefit?
The immediate non-obvious benefit is that $5,500 contribution is tax deductible right now. Since they're in the 28% bracket, that deduction instantly saves them $5,540 on their current year's taxes.
Okay, so the $5,500 contribution effectively only costs them $3,960 out of their own pocket.
Exactly. That $5,540 difference is money they would have otherwise paid in taxes.
Wow. So the government isn't just letting you defer taxes. It's essentially funding 28% of your initial investment capital right up front.
Precisely. It's like getting an immediate 28% return, or rather a huge discount on your investment cost before the money even starts earning anything. And that initial government subsidy, if you will, gets to compound tax-free along with your contribution.
That is a staggering head start.
It really is. Now, let's watch what happens over the long term. Compound that effect. Let's say you invest that $5,500 every single year, earning a hypothetical 7% annual return for, say, 45 years.
Okay, a long investing horizon.
Right. Now, if you did this outside a tax-advantaged account in a regular taxable brokerage account, those earnings would likely be taxed each year. Let's stick with our 28% example rate for simplicity on the gains.
So you're losing a chunk to taxes every year.
Yep. Tax drag eats away at your returns. After 45 years, your final accumulated value in that taxable account would be just over $900,000. Still a good chunk of change, but watch this.
Okay, now the IRA comparison, the initial subsidized capital plus all the earnings.
All of it gets to compound entirely untaxed year after year, decade after decade. That structural advantage lets the exact same contributions and returns grow to more than $1.6 million.
Whoa, that's nearly double.
It's a massive difference. Now, sure, you'll likely pay ordinary income tax when you withdraw the money in retirement from the traditional IRA.
Right, it's tax deferred, not tax free like a Roth IRA in retirement.
Correct. But even after accounting for those taxes later, the final net amount you keep is vastly larger. That difference, nearly double the final value in this example, comes purely from allowing the government's initial subsidy and all those subsequent earnings to compound without that annual tax bite interference.
It just perfectly illustrates why financial discipline, when married with smart, strategic tax planning, is the absolute key to really compounding wealth over a lifetime.
Couldn't agree more. It's about using the system.
All right, we've laid the groundwork. The mindset of ownership, the power of compounding habits, understanding the macro context of interest rates, and leveraging tax advantages like IRAs.
Solid foundation.
Now, let's apply that discipline directly to acquiring assets in real estate. This is where leveraging those financial principles becomes absolutely paramount.
Oh, absolutely. Real estate is fundamentally a leverage game in multiple ways. But when it comes to actually finding deals, the core challenge is, well, it's simple in concept, but hard in practice. Valuation.
Knowing what something is actually worth and what you should pay.
Exactly. You need to know reliably when you've actually found a genuine deal. And that knowledge really starts with revisiting Basic Economics 101.
Supply and demand.
Supply and demand. People buy more when the price is lower. Sellers supply more when the price is higher. This simple mechanism dictates how scarce resources like well-located houses or apartments get allocated in the market. Understanding that dynamic is step one. Hashtag 2.1 principles of real estate valuation and profit setting.
Okay, so understanding market forces is key. But when you're actually analyzing a specific potential investment, especially something riskier like a fix and flip or a major renovation project, you need a clear standard, right? A rule for setting your maximum purchase price.
You absolutely do. And the standard needs to be pretty rigid. The advice from the sources is clear. You always buy at a price that gives you a high probability of profit. And critically, that calculation has to factor in all potential unexpected costs because they will happen.
Always budget for surprises.
Always. Furthermore, the source material explicitly says you need to adjust your required profit margin based on the cost of the property itself.
Okay, why does the risk correlate with the house price? That seems interesting.
It boils down to market depth and liquidity. Think about it. Less expensive entry-level homes, they're almost always inherently easier to rent out quickly.
Bigger pool of potential tenants.
Right. And crucially, they're much easier to resell quickly in almost any market condition. There's just more demand at lower price points.
Yeah.
Now, contrast that with investing in a more expensive high-end house.
Okay.
If the market suddenly turns south, or maybe you just personally need to sell fast for some reason, finding a buyer for that high-end property quickly often requires offering a significant discount.
Less buyers at that price point, so you have to tempt them more.
Exactly. The risk exposure, the illiquidity risk, is just much higher. Therefore, your built-in minimum profit margin needs to be larger on those more expensive deals to compensate for that potential need for a faster, discounted sale. You need a bigger cushion.
That makes sense. Okay, so you've got the property right. Now you need to track performance beyond just simple, I made X dollars. Novice investors often confuse cash flow with rate of return. We need to get clear on ROI versus IRR.
Oh, absolutely crucial. Let's break them down. ROI, return on investment, that's the most basic metric.
The percentage gain.
Right. It's just a percentage comparing your gain or loss directly to the amount of your own cash you originally put into the deal. It's perfect for comparing, say, two different flips that both netted you $50,000 profit, but one required $100,000 of your cash up front, and the other only required $20,000.
So the ROI tells you which deal used your cash more efficiently.
Exactly. It answers the question, how hard did my invested dollars actually have to work?
Okay, then there's IRR, internal rate of return. This one often sounds more sophisticated,
Mm.
but you're saying it has some big limitations, especially in real estate.
It definitely does. IRR is a calculation that gives you a single annualized rate of return for an investment over its entire projected holding period. The math is complex, but the big pitfall is twofold.
What are the traps?
First, it completely ignores the size of the project or the total dollars returned. Second, and this is a big one, the calculation inherently assumes that all the cash flows generated during the life of the project, like monthly rental income, can be reinvested immediately at that same, often very high IRR rate.
And that reinvestment assumption is often unrealistic.
Very often impossible in the real world. You might get a great IRR on one deal, but can you immediately find another deal that yields the same high rate for the cash flow you just received? Probably not.
So a really high IRR could be misleading if the actual cash generated is tiny.
Precisely. You could have a small deal, maybe a single rental that generates, say, $500 a month in cash flow, but calculates out to a fantastic 15% IRR.
Sounds great on paper.
Yeah. But now compare that to maybe an 11% IRR, which sounds less impressive, but it's on a large apartment complex that throws off $25,000 in positive cash flow every single month.
Okay, the choice is obvious there if cash flow is your goal.
Exactly. If your primary goal is to generate passive income to replace your job, the larger deal with the slightly lower IRR is demonstrably superior. So the takeaway is, investors absolutely must balance that rate of return metric, IRR or ROI, with the total dollar return and the absolute cash flow potential of the deal. Don't get seduced by just a high percentage. Hashtag tag 2.2 strategic financing for new investors.
Okay, balancing metrics is key. But let's face it, the single biggest hurdle for most people starting out in real estate investing is getting the money, right? Capital access.
Absolutely. Number one barrier, usually.
And this is where the strategic use of leverage, which you called the financial superpower of real estate, really comes into play.
It really is a superpower, used wisely. Leverage is simply using borrowed money, OPM, other people's money, to increase the potential return on your own cash investment.
So you control a bigger asset with less of your own money down.
Exactly. It allows you to commit much less personal capital to any single deal. You can often secure loans for up to 75%, sometimes even more, of the total project cost. The huge benefit is scale.
Meaning you can do more deals.
Right. It enables you to purchase properties and undertake projects that you simply couldn't afford if you had to pay all cash. It magnifies your reach.
But wait a second. If we're talking about using high leverage, potentially 75% or more loan to cost, isn't the risk significantly higher? Being highly indebted feels dangerous, especially if you try to scale up and do multiple deals like this. How do you manage that added systemic risk?
That is absolutely the right critical question to ask. High leverage definitely amplifies risk just as it amplifies potential reward. You mitigate that risk primarily through two strategies.
Okay, what else?
First, ultra-conservative underwriting. You have to be absolutely sure that the property's income can comfortably cover the debt payments, even with high leverage, and still generate positive cash flow. Factor in vacancies, repairs, everything. Stress test your numbers.
Don't rely on rosy projections.
Never. Be realistic, even pessimistic. Second, and this links directly back to what we'll discuss more with taxes, you mitigate the risk by recognizing that leverage also scales up your tax benefits, particularly depreciation.
Okay. So the debt helps you acquire the asset, and the asset, even the debt-funded portion, generates tax deductions.
Exactly. We'll get into the mechanics, but leverage allows you to scale your tax sheltering capabilities right alongside your acquisition capabilities. But, okay, what if conventional bank financing, that 75% loan, isn't available? Maybe the property needs too much work or your credit isn't perfect yet.
Right. Then investors have to get creative.
They turn to creative financing options. Let's talk about a couple of key ones. First, there's the often expensive option, hard money.
Hard money lenders. What's their role?
Hard money is all about speed and financing deals that banks won't touch. Typically, properties needing significant repairs. These lenders aren't banks. They're private individuals or companies.
And they can fund quickly.
Very quickly, sometimes in days. They can often fund the entire purchase price plus the renovation costs. This makes them ideal for investors who might be short on cash or need to close incredibly fast to beat competitors.
Sounds great, but what's the catch? You said expensive.
The money is very expensive. You're typically looking at much higher interest rates, sometimes double-digit, plus significant upfront fees called points, often 2 to 5% of the loan amount just to originate the loan.
Ouch.
Yeah. So hard money is really only justified if you have found an absolutely killer deal, a true incredible deal, with a massive built-in profit margin that can easily absorb those high financing costs and still leave you with a healthy profit.
Okay, so hard money is a tool for specific situations. What about the second strategy, which you said is often more powerful for scaling? Seller financing?
Seller financing. This can be pure gold if you can negotiate it. It's basically a form of delayed gratification for the seller and creative structuring for the buyer.
How does it work?
The seller essentially becomes the bank. Instead of getting a lump sum cash payout at closing from your bank loan, they agree to carry the contract or hold a note. You, the buyer, make monthly payments directly to them, principal and interest, over an agreed-upon term.
So the seller gets income over time instead of all at once. Why would they do that?
Several reasons. Maybe they want steady income. Maybe they want to defer capital gains taxes. Maybe their property is hard to finance traditionally. Maybe they just like you and want to make the deal work. The source material shares a brilliant real-world example.
Let's hear it.
An investor managed to acquire a 24-unit apartment complex with only $15,000 of their own money down.
$15,000 for 24 units.
How? Because the sellers agreed to finance the rest of the purchase price themselves. They carried the note.
Wow, that seems almost impossible today. What was the ultimate payoff for the investor?
Okay, so the investor ran the property well for a few years. The value increased, the rental income stabilized and grew. Then they went to a local bank and refinanced the property based on its new higher value and proven income stream.
Using conventional financing this time.
Right. The new bank loan was significantly larger than the original loan amount owed to the sellers. So the investor paid off the sellers completely with the refinance proceeds and was able to walk away from the closing table with $100,000 cash in their pocket, tax-free at that moment.
That's incredible. They basically used other people's money, the seller's equity, to buy the property, build equity, and then pull cash out.
Exactly. That's the power of creative financing and appreciation.
Phenomenal. Okay, beyond hard money and seller financing, any other nuances investors need to know about the specialized lending world, like dealing with portfolio or commercial lenders?
Yes, a couple of key things. Unlike standard residential mortgage lenders who sell their loans off, portfolio lenders, often smaller banks or credit unions, keep the loans on their own books. This gives them more flexibility, but they often use different products. You'll frequently see adjustable rate mortgages, or ARMs, where the interest rate isn't fixed for 30 years, but adjusts periodically based on some benchmark index, like the prime rate. This obviously exposes the investor to interest rate risk if rates go up.
Something to watch out for.
Definitely. And perhaps more importantly, these lenders, especially commercial lenders financing larger properties, almost always impose something called a seasoning period.
Seasoning. What's that?
It means they usually won't agree to refinance a property immediately after you buy it, especially if you bought it with cash or creative financing. They want to see a track record, often 6 months to a year, where you've owned the property, managed it, maybe completed renovations, and stabilized the rent roll.
Why do they require that delay?
They do it to ensure the property is stable and performing as expected. They also want to make sure your initial purchase wasn't some kind of distressed fire sale, where you bought it way below its true market value, which would make their new loan riskier if you immediately try to cash out based on an inflated appraisal. They want seasoned value.
Okay, financing is sorted. Now we get to what feels like the real engine of long-term wealth for buy and hold real estate investors. This is apparently the reason why highly profitable investors can sometimes legally show a paper loss on their taxes.
You're talking about depreciation.
Exactly, depreciation.
And you're right, it is arguably the most powerful tax benefit in the entire IRS code for real estate owners. It's essentially the government's gift, acknowledging that buildings wear out over time.
So how does it work financially? It's a non-cash deduction, right?
Correct. It's a deduction you get on your tax return, even though no cash actually left your pocket that year for this specific expense. It allows you to deduct the cost basis of the property structure critically, not the land value, because land doesn't wear out over its IRS-defined useful life.
And for residential rental property, that useful life is?
It's currently set at 27.5 years. For commercial property, it's 39 years.
Okay, let's ground this with a concrete example. Say you buy a rental house.
Right. Let's say you buy a property for $500,000. The appraisal might allocate, say, $75,000 to the land value and $425,000 to the value of the building, the structure itself.
So you depreciate the $425,000.
Exactly. You take that $425,000 structure value and divide it by 27.5 years. That gives you an annual depreciation deduction of $15,455.
15 grand a year.
$15,455. That amount is subtracted from your taxable rental income every single year for 27.5 years. Even if the property is cash flowing positively, meaning rent covers mortgage, taxes, insurance, and repairs, this large non-cash deduction can often push your net result on paper into a loss.
And that paper loss can then potentially offset other income you have, like from your job.
Depending on your income level and other factors, yes, under the passive activity loss rules, it often can. This is the primary mechanism allowing a profitable real estate investor to legally show a paper loss and significantly reduce their overall tax burden.
Now, you mentioned earlier that leverage multiplies this. Can you walk us through why using debt allows this write-off to multiply, even though we didn't put up all the cash ourselves?
This is the really beautiful part, financially speaking. The key realization is that your annual depreciation expense is calculated based on the full purchase price allocated to the structure, not based on the size of your down payment or how much equity you have.
Ah. So it doesn't matter if I put 20% down or theoretically 0% down with seller financing.
Correct. You get the exact same $15,455 depreciation deduction on that $500,000 property with the $425K structure value in both scenarios.
So if I use leverage smartly.
Right. Let's say instead of buying one $500,000 property with a large down payment, you use higher leverage to purchase 3 separate $500,000 duplexes, maybe putting down less on each but using bank loans for the rest.
Okay, same total purchase value, $1.05M, but spread across 3 properties using leverage.
Now, assuming similar land structure allocations, you get to take that $15,455 depreciation deduction on each of the 3 properties.
So that's $15,455 times 3, over $46,000.
$46,365 in total annual depreciation deductions.
Wow. And that's generated potentially using the same amount of your own cash out of pocket as someone who bought just one single property debt-free.
Precisely. It's an exponential multiplier effect for generating paper losses, which makes using leverage, assuming the cash flow supports the debt service, a very tax-savvy strategy for accelerating wealth building.
That's a huge structural advantage.
Right.
Okay, but everything comes full circle. What happens eventually when you decide to sell that property, which is hopefully appreciated significantly in value, and you've been taking all these depreciation deductions for years?
Now you face the tax music, potentially. When you sell, you'll owe capital gains taxes on the appreciation, the difference between your sale price and your original purchase price. Plus, you'll owe something called depreciation recapture tax on all those deductions you took over the years. That can be a big tax bill.
Which brings us neatly to the famous 1031 exchange.
The holy grail for deferring those taxes. The 1031 exchange, named after Section 931 of the Internal Revenue Code, is the mechanism that allows real estate investors to defer, not eliminate, but defer paying those capital gains and depreciation recapture taxes when they sell a property.
How does the deferral work?
The rule is you have to take the entire proceeds from the sale and reinvest them into acquiring a like-kind property, basically. Another investment property of equal or greater value within a strict time frame.
So you swap one investment property for another.
Essentially, yes. You're rolling your gains forward. It's like getting an indefinite, interest-free loan from Uncle Sam on the taxes you would have owed, allowing you to keep all of your capital working for you in the next deal and the next and the next. You can potentially keep doing this until you die, at which point your heirs may get a step up in basis and eliminate those deferred taxes entirely.
That's incredibly powerful for building generational wealth. What are the absolute must-know rules for investors thinking about a 1031?
2 crucial ones jump out. First, the property you are selling must be held for investment or used in a trade or business. It cannot be your primary residence at the time of sale. You might be able to convert a rental to a primary residence or vice versa, but there are specific rules and holding periods involved.
Okay, investment property status is key. What's the second rule?
Timing is absolutely critical. There are very strict deadlines like identifying potential replacement properties within 45 days of selling the old one and closing on the new property within 180 days. We won't dive into all the details here, but missing these deadlines kills the exchange.
Get professional help for a 1031.
Absolutely. Use a qualified intermediary. Also, a related point. Always aim to hold your investment properties for longer than 1 year before selling.
Why 1 year?
Because holding for more than a year means any eventual capital gain qualifies for the lower long-term capital gains tax rates, which are significantly lower than ordinary income tax rates. If you sell in under a year, any profit is taxed as short-term capital gain, usually at your higher ordinary income tax rate.
Good tip. So navigating all this complexity, leverage, depreciation, 1031 exchanges, it sounds like you really need a good team around you. The sources often mention the core four.
Yes. Surrounding yourself with experts is non-negotiable for serious investors. The core four typically refers to your real estate agent, your lender, your property manager if you don't self-manage, and arguably the most vital member.
Your CPA?
Your CPA, yes, but not just any CPA. You need one who specializes in real estate taxation. They need to understand the nuances we've discussed, depreciation, passive activity losses, 1031s, and importantly, they need to be proactive and willing to help you take every single legitimate deduction you're entitled to.
Even the smaller ones add up.
They really do. Things like the home office deduction. There's a simplified method now where you can deduct $5 per square foot of your dedicated home office space up to a maximum of 300 square feet or $1,500 per year currently. $500 was mentioned in the source's context, but it's higher now. It's much easier than tracking detailed expenses for that space. A good CPA knows these things. At the end of the day, your success is often limited by the quality of your advisory team.
Okay, part 3. We've covered the mindset, the financing, the tax strategies. Now we transition to the operational side, actually mastering the physical asset and managing the people involved. Let's start with maximizing appeal, because that translates directly into faster sales, higher rents, more profit.
Absolutely. First impressions are everything in real estate, non-negotiable. Whether you're trying to sell a flip or rent out a property, it has to look its absolute best in the first 5 seconds a potential buyer or tenant sees it.
And increasingly, that first impression happens online, with the photos.
Exactly, which means those photos need to be outstanding. So my first checklist item: be heavily involved in the professional photo-taking process. Don't just leave it to the photographer or realtor. Make sure they capture the best angles, the best light.
Good point. What else is on that immediate checklist before a property goes live?
Simple things that signal care. Ensure the realtor's for sale or for rent sign is perfectly clean and standing straight up, not leaning crookedly.
Details matter.
They scream professionalism or neglect. And maybe the easiest, cheapest thing with the highest ROI: wash the windows. Inside and out, it maximizes natural light, makes the whole place feel brighter and cleaner. Often overlooked, huge impact.
Okay, moving from presentation to the hard structure. Curb appeal isn't just a new coat of paint, is it?
No, it involves physical integrity, too. Things like broken or badly sunken concrete walkways. They aren't just trip hazards. They visually scream structural neglect or deferred maintenance to a potential buyer. They must be repaired.
And upgrades can help, too.
Definitely. Replacing that plain, cracked concrete walkway with something more visually appealing, like brick pavers or flagstone, can dramatically enhance curb appeal and the perceived value of the home. And simple functionality matters. Make sure the garage door opens smoothly and quietly with the remote. Little annoyances add up negatively.
That makes sense. Okay, let's move inside. Let's talk about staging. The sources really emphasize balance in furniture placement, warning against using massive, bulky pieces.
Yes, it's all about the art of proportion. When you're staging a room, you have to avoid what one source vividly calls the gorilla walking two greyhounds effect.
Explain that.
It means if you put a really bulky, heavy piece of furniture, like a giant, overstuffed sectional sofa in a room, and then you pair it with very delicate, spindly little side chairs or tables, the visual imbalance is jarring.
The big piece looks even bigger and more awkward.
Exactly. It looms over everything, makes the room feel smaller and kind of classy. The goal of staging is harmony. Everything should feel like it's in proportion to the room and to the other pieces, creating a sense of calm and maximizing the perceived space.
Okay, proportion is key. What about color strategy? This seems like an area where novice flippers or landlords can easily go wrong, maybe getting too personal or trendy.
Oh, big time. The strategy should always be about creating harmony and broad appeal. The best advice: use an off-white or a soft neutral gray as your base color for the walls.
The Grege palette.
Pretty much. These neutral backgrounds act like a blank canvas. They allow potential buyers or renters to easily mentally picture their own furniture and belongings in the space. They don't clash with anything.
So you create that neutral base. Then what?
Then you soften that potentially sterile neutrality with natural elements. Things like green plants, even good quality fakes, and accents of plain, natural wood tones. These are universally appealing, add warmth, and harmonize easily with almost any accent colors someone might bring in later.
Any colors to absolutely avoid.
The classic warning is never use bright red and bright green together in main living areas.
Why not?
It immediately creates a strong visual dissonance, and for many people, unconsciously conjures up images of Christmas or holidays. You want timeless appeal, not seasonal.
Good point. Even super specific details like how high to hang pictures are apparently standardized for maximum appeal.
Yeah, it seems trivial, but interior designers and galleries have actually codified what looks best to the human eye in most settings. The American rule of thumb is often called the 57 inches rule, or sometimes the 145 principle in centimeters. Meaning the center of the picture, not the top or bottom, should be positioned 57 inches, which is about 145 centimeters, up from the floor. This is generally considered the average human eye level and provides the most comfortable and aesthetically pleasing viewing height for art in a staged or gallery setting.
Details matter. Hashtag tag 3.2, tenant acquisition and lease management. Okay, fascinating details on staging. Now let's switch gears a bit, focusing more on the long-term buy and hold strategy. The difference between a smooth, profitable rental operation and an absolute nightmare often comes down to tenant acquisition, right? Getting the right people in the property.
Absolutely. Tenant selection is probably the single most important factor in your long-term success as a landlord.
And the sources mention a somewhat counterintuitive strategy for attracting the highest quality tenants. It's not just about charging the highest possible rent.
Correct. The typical landlord approach is just maximize rent, get the highest number possible. The superior strategy, according to these insights, is actually to set your monthly rent slightly below the fair market rate for that property and area.
Below market. Why would you leave money on the table like that?
Because you combine that slightly lower rent with simultaneously charging a larger than average security deposit.
Okay. So lower rent, higher deposit. What does that combination achieve?
It creates this powerful self-selecting mechanism. The slightly lower rent attracts a wider pool of applicants, including financially sound, responsible tenants who recognize they're getting a good deal, a bargain.
They appreciate the value.
Exactly. And because they value that bargain rent and don't want to lose it, they tend to become lower maintenance tenants. They're less likely to complain about minor issues, more motivated to pay rent on time, and generally take better care of the property because they fear losing their good deal.
And the higher security deposits screens out less qualified applicants.
It does. It requires tenants to have more cash saved up, which is generally an indicator of financial stability. It also gives you, the landlord, a larger cushion against potential damages or unpaid rent if things do go wrong. So lower rent attracts the best, higher deposit protects you, it reduces turnover and headaches significantly.
That's a clever psychological play.
Yeah.
But regardless of how good a deal the rent is, you still need ironclad screening criteria to protect your asset, right?
Yeah.
What are the absolute non-negotiables when vetting applicants?
Oh, completely non-negotiable.
Yeah.
The sources are very clear on strict cash management upfront. Always require guaranteed funds, like a money order or a cashier's check for the security deposit and the first month's rent before handing over the keys.
Never accept a personal check for that initial move-in money.
Absolutely never. Think about the nightmare scenario. You accept a personal check, let them move in, and 2 weeks later that check bounces. Now you have tenants living in your property who haven't paid, you don't have the security deposit funds you thought you had, and you're immediately facing a potentially costly and lengthy eviction process. Avoid it completely with guaranteed funds up front.
Makes sense. What about red flags in an applicant's history? What's the ultimate deal breaker?
For most experienced landlords, the ultimate red flag, the absolute deal breaker, is a prior eviction on their record.
Why is that considered so serious?
An eviction filing is often described as the equivalent of committing murder in a landlord's eyes. That might sound harsh, but it signals a severe past failure to meet their rental obligations, likely involving non-payment of rent over an extended period, forcing the previous landlord to go through the formal legal eviction process.
Which is expensive and time-consuming for the landlord.
Exactly. It often results in months of lost rent, potential legal fees, and frequently significant property damage left behind by the evicted tenant. So, rightly or wrongly, a past eviction is seen as indicating a very high probability of future problems. Most landlords simply won't take that risk.
So set clear criteria.
Yes, you need to set and consistently enforce a minimum acceptable credit score. Credit score isn't perfect, but it does provide a general reflection of a person's willingness and demonstrated ability to pay their bills and manage financial obligations over time.
Okay, screening is crucial. Finally, let's touch on the psychology of negotiation. This applies not just to setting rents, but also handling tenant requests or disputes, negotiating with contractors, even buying or selling properties.
Yes, negotiation skills, or maybe better put, persuasion skills, are fundamental in real estate. And the core principle, especially in ongoing relationships like landlord-tenant, is that it's fundamentally about relationship building.
How so?
Simple human nature. People give better deals, are more cooperative, and are generally more pleasant to deal with people they like and respect. Your primary goal in most interactions should be to build rapport, not create antagonism. Avoid that aggressive, hardline, my way or the highway approach.
So what does that look like in practice? Say a prospective buyer or a tenant brings up a point you disagree with, or maybe contradicts a fact you've presented. You shouldn't just shut them down or tell them they're wrong.
Absolutely not. If you want a positive outcome, you actively avoid arguing, directly contradicting, or challenging their viewpoint head-on, even if you know they're mistaken. That just puts people on the defensive.
So what do you do instead?
You use softer, more conciliatory language. You hedge your differing views. You might say something like, "That's an interesting perspective. Have you also considered?" Or, "I can see why you might think that, but what if we were to look at it from this angle?" Or, "Help me understand where you're coming from on that."
Acknowledge their point, then gently redirect.
Exactly. This approach makes the other person feel heard and respected, not attacked. It keeps the conversation collaborative and makes them much more receptive to your viewpoint and much more likely to work towards a mutually agreeable solution. You're much more likely to get what you ultimately want.
And a final crucial point on handling tenants, especially when denying an application.
Yes, always. Always maintain meticulous records of your screening process and your reasons for choosing one applicant over another or denying someone. And when you do deny an applicant, make sure you have a clear, logical, fair, and legal business reason, like their credit score didn't meet your minimum standard, their income wasn't sufficient, or they had that eviction history we talked about. Document it. This protects you against potential claims of illegal discrimination. Hashtag 3.3, the wider context of property value and urban development.
Okay, great practical advice on management and negotiation. And let's zoom out again for the final section, looking at some of the bigger macro forces that shape long-term property value and where people choose to live. We could start with architectural context. Apparently, the vast majority of modern American homes owe their existence to a specific structural innovation way back in 1833.
That's right. It's called the balloon frame technique, and it first appeared in Chicago around that time.
Balloon frame. What is it, and why was it so revolutionary?
Before balloon framing, most houses were built using heavy timber framing, large posts and beams joined together with complex, labor-intensive joinery. Balloon framing instead used numerous lightweight standardized studs, think 2x4s running continuously from the foundation all the way up to the roof, held together simply with nails.
Much faster and cheaper to build.
Dramatically faster and cheaper. It required less skilled labor and used less wood overall compared to timber framing. This structural innovation became the primary support system for the vast majority of American homes built since the mid-19th century. It really stands in contrast to traditional European construction, which continued to rely more heavily on exterior masonry walls for support.
And this balloon frame made the suburbs possible.
It was a key enabler, yes. This rapid, affordable construction method fueled the massive expansion of new suburban neighborhoods all across America, particularly after World War II.
Interesting. So building methods changed, enabling sprawl. But now, are we seeing shifts in where Americans want to live? The sources suggest a move back towards density.
Yes, there's definitely a significant demographic and preference shift underway, favoring density and more mixed-use urban environments. This trend actually started back in the 1990s, but seems to have dramatically accelerated, particularly since the Great Recession around 2008-2009.
So people are moving away from that purely low-density, car-dependent suburban model.
Increasingly, yes. There's a growing interest, especially among younger generations and empty nesters, in living in denser, more walkable, mixed-use urban settings where they can live, work, and play without constantly needing a car. This has profound implications for real estate investment.
Meaning?
It suggests that well-located urban core properties near transit hubs, and properties in walkable neighborhoods likely have a strong, long-term tailwind of demand supporting their values.
But there's a potential dark side to this urban success story, right? based on the observations of the famous urban planning thinker Jane Jacobs.
Yes, Jacobs made some incredibly insightful and sometimes critical observations about cities. She argued passionately that a lack of functional diversity, a mix of different uses, old and new buildings, different types of businesses and people, makes a city district innately either depressing or vulgarly chaotic. You need that vibrant mix.
And she warned that economic success could actually destroy that very diversity.
That was her crucial, somewhat paradoxical point. She observed this process of successional self-destruction of diversity. What happens is, as a neighborhood becomes successful and desirable, property values and rents inevitably rise.
Gentrification.
Right. And that economic success starts to crowd out the very things that often made the neighborhood unique and vibrant in the first place. The quirky, independent, often lower margin uses. Think independent bookstores, small local cafes, artist studios, niche manufacturers. They can no longer afford the rising rents.
And they get replaced by chains or high-end boutiques.
Exactly, leading to a monoculture that can, ironically, make the neighborhood less interesting and less desirable in the long run. So as investors contribute to a neighborhood's success, they need to be aware of this dynamic and think about how to potentially preserve some of that essential diversity.
That's a really important consideration. Finally, let's touch on how technology is reshaping this entire sector. We hear a lot about prop tech. How is it changing real estate investment and management?
Prop tech, or property technology, is having a massive impact across the board. One huge area is leveraging fintech financial technology solutions to basically democratize access to real estate capital.
How so?
We're seeing the rise of crowdfunding platforms and peer-to-peer lending platforms specifically focused on real estate deals. These platforms allow smaller, everyday investors to pool their money and participate in large-scale real estate projects like apartment buildings or commercial developments with much lower minimum investment thresholds than were historically required.
So you don't need to be a millionaire to invest in big projects anymore.
Exactly. It promotes diversification for smaller investors and creates greater financial inclusion in an asset class that used to be hard to access without significant wealth.
That's a big shift. And for people looking to actually work in this rapidly evolving prop tech field, what kinds of skills are most valuable now? Is it all just about coding and data science?
Interestingly, no. While technology skills and cognitive abilities like data analysis are certainly important, recent analysis highlighted in the sources shows that the most sought-after skills in prop tech roles today are actually soft skills.
Like what?
Things like specialized problem solving, dealing with unique, complex situations, self-management, being disciplined and organized, and maybe most importantly, high-level teamwork and collaboration. The ability to work effectively with diverse teams to manage the inherent complexity of real estate and technology integration is absolutely paramount. Hashtag outro.
Wow. Okay. We started this deep dive way back with the idea of making just a 1% improvement each day. And we've ended up discussing massive global shifts in urban planning and technology.
We're quite the journey.
But I think what we've really established is that lasting financial success, especially in real estate, seems to be rooted in strategically aligning several key things. Those small compounding improvements in your own behavior and discipline.
Absolutely.
Rigorous systematization when it comes to executing your goals, like that 12-week year idea. And then layering on the strategic use of leverage, both financial leverage like loans and tax leverage like depreciation and 1031s.
It really is that combination. And it drives home the point that success in this field is generally systematic, not random or based purely on luck. Real estate wealth is most often achieved not by swinging for the fences on one risky deal, but by surrounding yourself with those expert advisors, the core four we mentioned.
Right.
And then consistently, relentlessly executing a proven, well-structured system. Whether that's the BAR method, buy, rehab, rent, refinance, repeat, or meticulous tax planning or disciplined underwriting. You know, the saying goes, you don't rise to the occasion under pressure. You fall to your highest level of preparation.
And taking the long view seems critical too. We often get caught up in immediate returns, today's hot market. But the sources really encourage us to think like value investors, even when looking at publicly traded real estate assets like REITs.
Exactly. Look past the immediate metric sometimes. We touched on that historical example. Before REITs became mainstream, they were often priced quite cheaply. They offered maybe a reliable 5% dividend yield, combined with perhaps 5–6% steady annual growth in the underlying asset value as rents increased.
Joe, add those together.
You get an 11% or higher total return compounded over decades. Achieving that required investors to focus less on today's price-to-earnings ratio and more on the quality of the management team and their realistic estimates for net asset value, NAV growth, over the long haul.
Looking beyond the surface.
Precisely.
So the final provocative thought we want to leave you with today is this. Considering everything we've discussed, the power of compounding habits and tax advantages, the long-term shifts towards urban density, the importance of systems and preparation, what current, maybe seemingly undervalued real estate sector or type of asset or even geographic area are you perhaps overlooking right now?
Yeah, what might you be dismissing because your focus is too narrow or too short term? Where might the real long-term value lie if you look deeper, focusing instead on its potential highly systematized growth trajectory over the next decade or two? Something to think about.